How's it going, everyone? My name is Alex from the Aussie Financial Journal, and today I'm back with another video regarding 3 great dividend-paying companies for February. The purpose of this video is to give you guys a couple of options that you might be able to look at just to build a passive income portfolio in February. So the first company we're looking at today is Woolworths. Now, Woolworths is obviously a leading player in the grocery markets. It's obviously a large supermarket chain. It's built up a bit of a reputation as being a very reliable dividend company and one that has excellent fundamentals. It's a sort of hedge as well against a recession in the sense that a lot of people buy this company because they fear a market collapse, and if that was to happen, people would still need to go to the shops and buy food. So it's very defensive in that situation and is very attractive in that regard. So for the year 2019, the Woolworths share price has actually seen an appreciation of about 24%, which is very strong, even given that there was a bit of a downturn towards the end of the year. And if you neglect that part of the market, you'll actually see even more returns coming into 2020, which is quite impressive. In saying that though, the earnings of Woolworths Group as a whole has actually been flat for 3 years, with a couple of percent up and down, which means it isn't delivering very strong growth in terms of its profit. However, shareholders seem to be very confident in this stock, and they think it's going to be growing over time. So we've seen very strong returns and we've seen very strong confidence in this share, and that's another couple of reasons why maybe you should be interested in it. So currently the Woolworths dividend is paying at about 2.4% trailing, which means it's not a huge dividend payer, but again, it's very reliable, and shareholders seem to be after that consistent growth and that consistent reliable income from its share. It is trading at a high price to earnings ratio, which means that you should be very cautious about what price you buy into this one. But again, if you're looking to open up a position in your portfolio that's more defensive minded, something that's going to, in most cases, it's going to be very reliable, then this might be a good option for you. So the next company I want to talk about is WAM Global. WAM Global is a listed investment company that's run by Wilson Asset Management, which is a leading listed investment company in Australia. Since its inception, WAM Global has actually produced an annualized return of about 10.2%, which is quite strong. But this is given that it's actually quite new and it was only released in, I think, 2018, which means that it's quite new and there's not much evidence to go off or information to go off for this one. As of the 31st of December, WAM Global has indicated that the NTA of the actual shares are about $2.45. So the NTA is essentially the net tangible asset value of the shares, which essentially means that if you're buying into WAM Global above the NTA, you're actually paying a premium for the underlying holdings. Currently, it's trading below the NTA, which means that you're actually buying into shares that have more value than their underlying holdings, which is always a good thing. So bear this in mind if you're going to be looking to make a purchase. As for dividends, WAM Global has paid one dividend since its first release, which was a 2% inaugural dividend. This amounted to about a 1.26% dividend payout, which is obviously very low for a dividend share. But you need to consider this in context. Wilson Asset Management is a long-term listed investment company that looks to grow its dividends over time. If you look at the performance of some of its other funds, you'll see that they grow their dividend over time, and they always look to maintain a stream of fully franked dividends. Indeed, WAM Global has actually indicated this objective for their fund to grow it over time and to continue paying those fully franked dividends. So definitely this is a holding which you would probably look for in the long term. If you're looking to get in and out, this isn't something you should buy. So this is one of those options that you can consider if you're going to buy and hold for the long term. So the final company I want to talk to you about today is Scentre Group. Scentre Group is the owner and operator of Westfield, which is obviously a huge shopping chain in Australia and in New Zealand. Currently has about 42 very high quality and large shopping centre under management, and this comes to a total of about $54 billion, which means they have a very high market capitalization and lots of assets under management. Now, the upside to this particular company is the kind of business model it has. If you think about the revenue and the way they make money, it depends entirely on the tenants in their shopping centre, for the most part. So what's important for a business model like this is the occupancy rate of the shopping centres. This basically means that over time, as they grow more tenants, they can actually develop more income from the leases that they give out, and they can also expand the shopping centres and bring in more tenants. So historically, Centre has had a really high occupancy rate of good quality tenants with long-term leases, which means that their revenue stream is quite strong, and means that their business model is actually profitable and can grow over time. The dividend yield is about 5.4% for Centre Group, which is very competitive, which obviously above the 5% rate, and is a good amount of income for people looking to build a portfolio of passive income. But also bear in mind the flip side to this type of business model. If you're one who's very skeptical on the retail sector, and if you're afraid of sort of the e-commerce that's coming up and the way it's so easy to shop online, it might be more prudent to stay away from this type of investment, because you might have to look into whether the e-commerce is having real impact on the retail space, and it could drive down competition and it could drive down revenue for this type of company in the future. So bear that in mind. So there you have it. There's 3 companies that I feel are great potential buys for February. They would fit very well into a passive income portfolio. I wouldn't dedicate a huge amount of capital to any one particular holding, but these are 3 options that you can sort of consider. They have very reliable income. They might grow their income over time if you've done your research and you think that they're going to remain profitable. So there, thank you very much for watching, and I'll see you guys next time.